Let's talk about a financial strategy that seems to completely flip common sense on its head, one where you actually make money when things go down. Welcome to our explainer on the totally fascinating and, yeah, often misunderstood world of short selling. You've heard the old saying a million times, right? Buy low, sell high. It's the bedrock of investing. But what if you could do it backwards? What if you could sell something first when the price is way up here and then buy it back later when the price is way down there? Sounds impossible, doesn't it? Well, that's exactly what we're digging into today. Okay, so how on earth is it possible to sell something you don't even own? Well, the answer starts with something pretty fundamental, trying to figure out what money in the future is actually worth to us right now, today. Imagine you have a bond, and it's going to pay you some cash in 6 months, then again in a year, and then again in 2 years. You can't just add those numbers up to get its price. Why? Because a dollar in your hand today is worth more than the promise of a dollar next year. So how do we solve that puzzle? It really comes down to two sides of the very same coin. We can take money we have now and figure out what it'll grow into in the future. Or, and this is the important one for us, we can take money we're going to get in the future and pull it back to the present to see what it's worth to us right now. And that process, that magic of pulling future money back into today's terms, has a name. It's called discounting. And honestly, it is the absolute key to pricing almost everything in finance, from the simplest bond to the most complex company stock. So if we're discounting future money, what determines how much we discount it? Well, it all boils down to two really powerful forces: interest rates and, of course, risk. Here's the core relationship you need to get. Think of interest rates as the price of waiting. The higher the interest rate, the more it costs you to wait for that future money. So you discount it more heavily, which means its price today is lower. It's a simple inverse relationship. And you can see that relationship perfectly right here. As the yield, which is just another word for the interest rate, goes up, the price of the bond goes down. It is a perfect financial seesaw. One side goes up, the other must come down. But that raises a question, right? Why would two different bonds have two totally different interest rates? The answer, my friend, is credit risk. It's that simple, nagging feeling that the person who owes you money might not actually pay you back. Think about it. A US government bond is pretty much seen as risk-free because, hey, the government can always tax people or print more money to pay its bills. But a company can go bankrupt. So to convince you to take on that extra risk of loaning them money, they have to sweeten the deal. They have to offer you a higher yield, a better reward for your gamble. Okay, so we get the what of pricing. Now let's talk about the who. Who are the actual players in this game making all these trades happen? Let's meet the institutions that keep the gears of the market turning. So, the market is basically split into two camps. You've got the buy side, think pension funds or mutual funds. They're investing huge pools of money for their clients. And then you have the sell side. These are the big investment banks, and their job is to make a market. That means they stand in the middle, always ready to buy from or sell to the buy side, making sure trading can always happen. And how do they do that? Well, they always quote two prices. There's the bid, which is the price they're willing to pay you for something, and there's the ask, which is the price they're willing to sell it to you for. And that little gap in between the two, that's called the spread, and that, my friends, is how they make their money. You know, if you've ever changed money at an airport, you've seen this exact thing in action. They'll sell you Japanese yen at a high price. But if you turn right around and try to sell it back to them, they'll only buy it at a lower price. That gap is their profit. It works the exact same way on Wall Street, just with stocks and bonds instead of yen. All right, we've got the theory, we've got the players, now it's time. Let's finally solve the big puzzle we started with. How in the world is it physically possible to sell something that you don't actually own? So we're back to our paradox, that amazing trick that lets you flip the script to sell high first and then buy low later. It's called shorting, and the whole thing kicks off with a simple act: borrowing. Here's the 5-step playbook. First, you borrow a stock or a bond from somebody who already owns a lot of it, like a big pension fund. Step 2, you immediately sell that borrowed security on the market for cash. So now you have money, but you also owe someone that stock. Step 3, you wait. You're hoping and praying the price goes down. Step 4, you buy that exact same security back, but now, hopefully, at a much lower price. And finally, step 5, you give the security back to the person you borrowed it from. The difference between the high price you sold at and the low price you bought at. That's your profit. Now, that all sounds pretty clever, right? But make absolutely no mistake, short selling is a high-stakes, high-risk gamble. So let's look at the dark side and the surprisingly important role this whole thing plays in the market. First things first, it is not a free ride. You have to pay interest to the lender for the privilege of borrowing their asset. And on top of that, if that stock or bond pays out any income while you're borrowing it, like a dividend or a coupon payment, guess what? You have to pay that amount to the lender right out of your own pocket. And that brings us to the single biggest, scariest danger of shorting. You are making a bet that the price will fall. But what happens if you're dead wrong? What happens if the price doesn't just stay the same? What if it goes to the moon? Think about it. When you buy a stock, the most you can possibly lose is what you paid for it, right? The price can only go down to zero. But when you short a stock, there is literally no limit to how high the price can go. And you are on the hook to buy that stock back, no matter what it costs. Your potential for loss is, in theory, infinite. So if it's so incredibly risky, why do we even allow it? Well, because short sellers play a vital role. They are the market's skeptics, its detectives. They put pressure on companies that might be overvalued or, in some cases, are outright frauds. They help push prices back down to a more realistic level. Without them, you could have markets get totally stuck, where sellers are asking for crazy prices that nobody is willing to pay. And this leaves us with this really critical tension. Shorting is absolutely essential for keeping markets honest and efficient, but it can also pour gasoline on a fire during a panic. So the real question becomes, how do you manage that risk without completely silencing the market's most important critics? What happens to a market when you take away its natural balancing force? That's the tightrope that regulators, and all of us really, are always walking.